everybody. Thank you so much for joining us today for our presentation to present our newest investment opportunity into Williamsburg, Brooklyn, New York. My name is Laura Nieves, and I am proudly responsible for Astor Realty Capital's investor relations and operations. Firstly, I would like to say a few words about Astor Realty Capital. As many of you are aware, we're a private equity firm and currently participating in over $1.7 billion of assets. Our existing portfolio consists of assets in New York City, Chicago, Florida, and other major markets. We are headquartered in New York and we have operations in Miami and Phoenix. Our host today is Joe Berko, co-founder of Astor Realty Capital. Over the course of Joe's 25-year career, Joe has structured, raised, syndicated, and sold over $3 billion in commercial real estate deals.
So what we're doing here is we're buying with Joel Schwartz and Southside Units a piece of land in the north portion of Williamsburg. Williamsburg, for those who are familiar with the neighborhood, it's sort of like the epic center of art, culture, culinary, young, vibrant club areas, great shopping, great retail, just a wonderful, wonderful vibe. It's very, very close to Manhattan, attracts a lot of attention. Prices are going through the roof over there. And while this is not a condominium, this is going to be a rental project. Rents are following and are doing great just as well. So in this particular deal, what we're doing is we're actually acquiring in the north side of Brooklyn, not too far away from the L train, which gets you to the city in about 10-15 minutes, a piece of land, a warehouse. It used to be a very industrial neighborhood. So we're acquiring to build 27 residential units, 22,000 square feet. Total budget is just shy of $18 million. We're going to be using about 12.2 million of first position mortgage and capitalize $5.6 million in equity. We'll come in with about 4.45 million dollars from our side. We'll own 80% of the project. Joel Schwartz is coming with 20%. We always like to maintain this balance. We like to see skin in the game. We spoke about it before. Those with skin in the game tend to stay in the game. They care. We believe the project valuation, once stabilized, completed, rented out, will be around $24.5 million. And so what we've done is we've created a preferred position. Essentially, the preferred position removes us away quite significantly from fluctuations in the market. Market goes up, market goes down, our returns are fixed. We've created an 18.5% return on our investment amount. And after paying our promotes and our fees and all that good stuff, our investors are going to end up with about 15, let's just shy of over 15% a year. Total duration of the project is 36 to 42 months. So in other words, we have to get paid our principal amount by the 42nd month. It's part of the agreement. We're starting in January, and our payments are going to happen several times during the project. So payment number one will be 18 months. It could be sooner. Okay, but 18 months is kind of like the longest that our partner can wait before he pays us. And so at that point, it will be a year and a half. So it's about 27 and a half. So their investors will get to see a check of about 22.5% over their investment, actually 22.68%. So let's take a look a little bit more about this project. So why we like the deal, it's a preferred equity position. Again, we play in equity, we're in the equity stage, but we're a little bit more accelerated. We have a short duration that gives us nice return and gives us the payments during, okay? I think that makes it very unique. Usually most of our project is you enter today and you exit in 3 years or 3.5 or 4 years. We don't go longer than 4. But you get to see the principal back and your return back in 4 years. This one, you get to see them during different intervals. The developer's personal guarantee our capital, okay, so invested capital. It's a big deal. Joel Schwartz, Southside Units, they're very, very serious guys, very big guys. I don't like to make big claims, but they've been around the block for almost 25 years, 24 years. They've built up this amazing portfolio. Most of it, it was ground up. Some of it was acquired and outfitted and renovated. And they are laser focused. This is a group that's constantly stays in Brooklyn. They know neighborhoods inside out. They've been there for almost a quarter of a century. And the growth mode is substantial, but only in those specific neighborhood in Brooklyn. So we feel very good about them. This is a guy with very deep pockets. It's nice to get a signature. It's also nice to know what sort of financials are behind the signatures, what sort of capabilities behind the signature, because we are talking about over almost $4.5 million, that there has to be a guarantee over here. And it's quite rare. It's quite rare to see something like this. The location is fantastic. I lived in Williamsburg. Anybody do a quick Google search for those who are not familiar. It's located in Brooklyn, as I mentioned. It's a location close to everything, and it's kind of like its own little enclave. And as I mentioned, it's a very highly established developer. This is not our first project with him. Essentially, the business plan is, as I mentioned, is to acquire a piece of land to build something quite small compared to the rest of the project that Southside Units and Joel Schwartz tend to build. And because of that, we're sort of giving the opportunity to, during the 3-year project, 3.5-year project, to stabilize the first, pay us our interest, and move on to the second project. We'll get sort of like the final say if we'd like to move forward or not. We essentially are going to make sure that it's going to look very much the same. Same in location, same in characteristics. So it cannot be a second project that what we call the rollover. It will not be a hotel. Okay, it will not be in northern New Jersey. It will not be in a location that is different. It will not have different characteristics. It's obviously not going to be identical. It's going to have a lot of the same characteristics. The rest of the information here in this business plan essentially describes what I've spoken about until now. The structure that we've created, which I think is a unique structure, it comes from trust. I've got to say, I'm pretty happy with it. We're getting a lot of response and a lot of requests actually from our investors to look into projects where there's an ongoing payments, where there's maybe shorter intervals. I think that answers those requests. I'm not going to bore you with all the details. Obviously, Laura will send it all to everyone to read. Williamsburg, there's a lot to be said about it. There's a lot of great statistics. Household income is very high. It's one of the most expensive neighborhoods in Brooklyn. Okay, it's probably competing very well with Brooklyn Heights and Dumbo and possibly one other neighborhood, but they're all considered very, very high. The loft buildings over the years have been converted, in the industrial warehouses have been converted to very high-end residential, both rentals and lots of condominiums. Shopping is a vibrant, rents, I think, in the spot, which is, I believe, by the way, not too far away from where it is. It's a few blocks away, but I would call what would be Main of Williamsburg. So that will be Bedford and North 7. Rents can reach as much as $400 per square foot, unprecedented amounts. Again, easy transportation, one subway stop from Manhattan, 10-15 minutes drive to Wall Street, half an hour drive to Midtown Manhattan. And it's just a status. The story of Brooklyn in itself, probably Williamsburg as the leading cause of it, is that it used to be, Brooklyn used to be, you couldn't afford Manhattan, so you went to Brooklyn. And so over time, it became cool to live in Brooklyn. And then now it's a status. Okay, so it went through all those neighborhood life cycles in the last 20, 25 years into what was considered to be a status. There's many neighborhoods in Brooklyn right now that are more expensive than certain neighborhoods in certain areas of Manhattan. Some have surpassed Manhattan locale by quite a lot. And the trend is continuing. We have a good number of projects going on in Brooklyn right now. It's a vibrant location. It's a fantastic and very, very strong market. And quite frankly, a lot of the draw of Brooklyn is individuals relocating from Manhattan, not because it's cheaper. It's never because it's cheaper. It's many other reasons. The timeline of this project obviously is very important. The land is, in fact, I might have misspoke before. The land has already been acquired by Joel. So obviously we're entering at the same price point. He's been going through the early stage of planning and getting the permits, and the demolition. There was a little bit of a warehouse over there that's been demolished. So we're sort of like moving along the process. We're looking at about 12 months of construction. Stabilization should not take 6 months. We're saying 6 months. I expect stabilization, 27 units in that specific location should take, without exaggeration, 45 days, 30 days, 60 days the best. And at that stage, conversations with the next bank, the bank that will take away our construction loan, will start commencing. Sometime between month 12 and month 18, we're going to get paid. That's payment number one. And then we're going to roll our capital, our invested capital, not the interest, of course, but the invested capital is going to roll over to project number two, where we're going to kind of like rinse and repeat and go forward. Now, it is a 42 months project. We're given some timeline to any delays that may not happen or anything like that. And so, but the intervals are the same. So it's 18.5% a year project level. We as Astor from our promotes and everything are generating a little bit over 15% return a year to our investors. Payments are done every 18 months, and the returns is, as I mentioned before, a little bit over 22%. In fact, 22.68% every 18 months. As typically we go through our capital stack, we have a senior debt just shy of 70%. Astor is going to have 80% ownership of the project through this preferred equity position, but ownership of the project is 80%. The developer, of course, is bringing 20% and is handling and managing the day-to-day. We manage the month-to-month, the major decisions. In terms of breakdowns, those who are signing up for the project or are interested in the project and want to go through the full length due diligence will obviously have a full breakdown of each and every line item. What's the hard cost composed of? It says many, many line items. What are the contingency composed of? Soft cost, financing, all that will be available in our Dropbox, and of course, all the other legal documents. So we're underwriting the project to understand the viability of it. Essentially, we're looking at about 1.3 in a gross rents, $59, just shy of $60 per square foot. These are not high numbers. I think we'll be able to achieve more. Again, achieving more in a preferred equity position doesn't better our position. Our interest is fixed. Okay, we're not alone, but our coupon is fixed. We have some parking income that we underwrote, some miscellaneous income, taking out some vacancy and collection loss. We're looking around $1.3 million in net operating income. This property is obtained a 421A tax benefits. Essentially, 421A gives us freezing the taxes for a period of 35 years, which is pretty great. $21,000 is when the land is vacant. Typically, what happens when the building is essentially built, then soon after, the tax assessors knocks on your door and says, "Hey, that used to be your taxes prior to building the building. We used to charge you $21,000. Today, you have a $25 million asset, and so your taxes are going to jump obviously quite significantly." However, because we have the 421A tax benefits, we're freezing taxes over a long period of time. I think it's 25 years. And after 25 years, the last 10 years, it goes up by increments until it's fully amortized to the future value then. We have a very long period of quiet, so we don't have to worry about that. And it's, again, one of the reasons why the deal is super hot and very, very strong. The rest is insurance, water, soil, utilities, repair and maintenance, elevator services, all that stuff together. We're looking at around $135,000 in expenses, leaving us with an NOI of about $1,166,000, which makes it the yield on cost. We don't have this calculation here. We do have it in our due diligence. Our yield on cost is a high 6.5%, which is quite nice for this area, for this location. We anticipate that a project like this should sell for somewhere in the vicinity of 4.75 cap rate, maybe 4.5 cap rate, into a market that is just thirsty for anything to do with Brooklyn, Williamsburg, certainly north section of Williamsburg, which is considered the hottest section. So I think that there's plenty of values there. Again, we don't participate in the upside and we don't participate in the downside. We are essentially a coupon clicker with a lot of say. The project continues. With Joel Schwartz, the larger projects, we'll spoke about our previous project in a moment, But our larger project, we take a different standard. This is an easy project for Joel. He just, sort of like, I don't want to say walk in the park. Nothing is, but it's considered a very easy project for him. He's probably built over 60, 70, 80 of those in his 24-year career. In this example, we're looking at our typical $100,000 example where an investor obviously can come in. A minimum investment amount here is $25,000. We want to make it attainable. We're only holding about $453,000 to our friends and family. $4 million is committed to our institutional capital. And from it, we're kind of sort of like chopping it up to about $25,000. We're putting some money obviously as well. And then there's always the investor participation fee. So considering this example of $100,000, we're looking at the timeline of 36 to 42 months. Over 36 months, right? The shorter duration, we're looking at 47%, $47,625 in return. That represents $147,625, $147,625 that the investor will get back. So including ours, $100,000 invested plus his return. The annual return is 15% net to you, the investor, 15.12%. Since you're getting paid every 18 months, the calculation of that will be 22.68%, right? It's a year and a half, so it's 15 plus the additional difference, so it's 22.68%. And the total return is 45%, or if it gets a little bit longer, so in other words, if it extends to 42 months, it's going to be just shy of 53%, 52.92%. Again, just a small breakdown. This is again focused on 36 months. If it becomes 42 months, assume it's going to be a little bit higher. Okay, so the longer, the higher. Our position for the friends and family, we allocated $453,000. We're anticipating $251,000 based on 36 months, to remind you. And then we go through our normal structure. Our normal structure means that you, the investor, will make additionally an 8% return before Astor will start participating in your success, right? In the returns that your investment creates. So 8% to you first on an annualized basis. After you get your 3 years worth of 8%, $142,000 based on this amount, Astor will generate itself $35,000 for the work that it has done for the last 3 years. Total distribution to the investors. Again, this is including the full amount, not the segmented amount. So 453,000 will generate 216,000 in return, net return. So total capital, once you return your capital back, we're looking at a total return of 45 and then 15% on an annualized basis. Again, because it's once every 18 months, it's a little bit over 22%. A little bit about Joel and Southside units. As I mentioned, they've been around the block for well over 20 years, around 24 years. They're only focused on Brooklyn. They build amazing buildings. They have a great team. They've been working with the same people, over and over, same contractors, same subcontractors, same architects, not always the same one or two people, but they're very active. So there's a small group of architects that they go to. We feel comfortable with them, straight shooters. We feel very, very good with the work that they've done, visited a good number of their projects and always been very impressed. The one thing he kept on asking is, don't you guys have a passport to live Brooklyn? There's other areas where you can build, but they love Brooklyn, and we love people that are laser focused, so it works. This particular project we started together several months ago. It's building 227 units in more of a blue collar neighborhood, not Williamsburg. Williamsburg is considered more of a luxurious, urban, cool neighborhood. There's more of a blue collar neighborhood where we're stepping into this asset. Again, we're 80% of this project as well. Actually, no, I'm wrong. Over there, we're 56%. We're still the majority. Joel Schwartz brought in about the difference. 36%. And, we're building a phenomenal project. It's going to have also a lot of elements. There's going to be some affordable units over there, some affordable elements. So I'm very excited about that project. We felt it was important to give you a little bit of a hint about the type of work that we're doing with Joel outside of this intended transaction. A little bit of his structure is high-level individuals. He's got a very large team, but essentially it's high-level individuals. We have their bios. We have good familiarity, good individuals. You have a snapshot into the majority of his portfolio. This is not all of his portfolio, but the majority of the portfolio. We track buildings. We don't just track our investment. We track how other buildings are doing, how the portfolio is doing. When we do our due diligence, I think it's important. We never want to step into some sort of a house of cards when one falls and everything falls with it. Now, although there's no legal connection between the two, our investment is a standalone LLC, single purpose LLC. We always want to know how much leverage our partner is taking, how much construction he has going on at any single moment, how much debt does he have, what's going to stabilize. We always look for those things. So it's never sort of like specific. Our due diligence never ends as specific to one unit. We also like to do like a global understanding of the investor, the developer, and the folks that we work with. So we'll share that with you. Obviously, this is confidential information. So, try to kind of sort of like keep it to the ones that, if you need to consult with an attorney, if you need to consult with an accountant, that's fine, but try not to kind of like, get it out there too much. And not that I assume anybody would. As I said, we have 27 units, 15 of which will be 1 bedrooms, and the rest will be 2 and 3 bedrooms. The comparables that we have, because we have a partner that has so many buildings in the immediate vicinity, we didn't have to go and compare to others, although we've done that as well, but we didn't have to go. We can literally pull away comparables from his own portfolio to see how well he's doing in certain buildings that are surrounding this particular site. So we feel good about those numbers. The more of a comparables that we pulled away from other properties. Our folks have done some work here on a good number of buildings, and the information is quite easy to find. It's a vibrant location. Everyone's advertising their rentals and how much they're renting for, and all kind of different information. So it's fairly easy to understand. We're in the vicinity of where we're expecting things to land. And being a preferred, if the building does a little bit less, the rent is a little bit less, if the expenses end up being a little bit more, we'd like to know, and we will, and we're tracking everything, but it's not going to have a negative effect, or for that matter, a positive effect on our investment because of our position. Location summaries, for those who are not familiar, we're looking into 1 subway stop away from Manhattan. On the L train, we're surrounded by everything Brooklyn has to offer, and Brooklyn is known for, from the most amazing clubs to great restaurants to office districts to just everything, art and festivals. It never ends. Brooklyn doesn't, they say Manhattan doesn't sleep. It never ends over there. There's always something going on, and it's usually sort of like the forefront of those things, whether it is in the restaurant space, culinary, and everything else. It's a wonderful place. For those who haven't been to Brooklyn or haven't had a chance to visit, I highly encourage you. More information about the neighborhood, I'll let you go through it if this is something that is interested. For those that are new to Astor Realty Capital, we do a short kind of like why Astor, 5 reasons why Astor. And so I'm happy to take you through it. Essentially, preservation of capital. Preservation of capital means that when we underwrite, we always want to know that we're conservative enough that if things will not go well, we know how to preserve our capital, how to exit, and how to make sure that we deliver on what we're promising. We go through about 300 to 400 transactions a year, 300 to 400 times where we're being asked to participate in projects. Our approval funnel is actually 98% no. So we really do choose about 8 to 10 projects a year that we're participating. And we go through a very rigorous process. Why not? Okay, so preservation of capital is extremely important. We work hard for our money, so do you, and we'll do everything possible to make sure that we maintain it. Nice to get good returns, but maintaining the capital and preserving it is the highest and far most important thing. Ongoing asset management. We are staffed. We have 3 offices between Manhattan, Miami, and Phoenix. And we also have a partnership in Israel. We're well staffed. We have asset managers that are looking into the project, tracking where the money goes. Are we on plan? Are we on timeline? Is everything going according to schedule? So we don't just sit back and expect our partners to do what they need to do. We're there to manage the project with them. As I say, they manage the day to day, we manage the month to month. Above market return, thank God, so far so good. I mean, we went through some pretty significant crisis, right? We're still going through one. Our investors are happy. There's been almost no instances where we had to downgrade our expectations, and a lot of instances we've upgraded our expectations. So certain projects are doing better, certain projects are doing much better. We do have one project where we're kind of like, watching it very carefully to see that the market is truly there. But even that one will probably generate a double-digit annual preferred return, so somewhere in the teens. So, we're doing mark to market. Things always change. We track everything, so we're able to give the right answer to whatever situation we're facing with. Alignment of interest. My money goes in, my partner's money goes in exactly the same way that you place your capital. It has the exact same risk. I don't have different return expectations than anybody else. I make our profits based on doing a good job. We take some asset management fee, but essentially we have the same amount of risk. Our capital is there alongside everybody else. And of course, the personal approach. Those that have been working with us have, I believe, enjoyed the transparency, the easy access to us, getting myself on the phone or having Laura on the phone or other members of the staff, or any situation where you need to access the documents. You have your own portal, you have your own information. Everything is organized for you. And if there's ever a need for anything, we're always available. And I think that part of the reason that we have a repeat business, almost with no exceptions, the fact that the repeat business also tends to increase it by introducing us to other friends and family and so on, is probably a good testament why. I'll skip this part, I always do. The 2 key founders of Astor Realty Capital, both myself and Michael Corinne. We started this after working together for about, I think, 7, 8, 10 years. And started the Astor Realty Capital with the concept of allowing us to move away from just being advisors, not just, but being advisors to large companies, public companies, private companies in the space of real estate and commercial real estate, to effect investing in real estate and allowing our friends and family to participate in what we consider to be high quality institutional level real estate. So small capital, high quality real estate, and creating a portfolio was and still is our mission, to make sure that whatever we have, the knowledge that we have, will help our friends, our family, to just do better financially. And whichever it means something different to everybody. So just do better financially. And I'm happy to say that it's growing. It's even growing exponentially. I'm not trying to minimize our work. It's a lot of hard work, and we have great people. We have an amazing team. We have a very, very solid team. Most people have been with us for well over 7, 8 years. And of course, we're hiring now because, there's a lot more that comes in. And we just, it's a lot of work, but we enjoy what we do. Few of our select investments, you can ask Laura to send you our full portfolio. We break it down. We do it quarter by quarter, where we upgrades or we do some downgrades to certain properties, but it's growing. I think we now surpassed about 1.6 billion in participation, overall participation in projects. We're in 10 different markets. Going Q1 will be in 10 different markets, 5 different states. There's just a lot happening. A lot of great stuff is happening, and I'm happy you're here. I'm happy we're able to share it with you. So the collective between myself and Michael is about 60 years of experience. In fact, it's, it's probably over 60 years once we put our collective experience together. And growing. I think that next year is going to be a very, very important year. And I feel that the company is at the tipping point. I feel we're ready. Okay, the foundation is very strong. I feel very good about it. And there's a reason why we're getting a big amounts of capital to manage, why we're getting more and more requests, when there's such a natural push. I think the work is probably the work is a testament. And I'm happy to say that things are going well because we're not, took our time. We built it very, very slowly. We created a very strong foundation, and it's time for us to expand on that foundation.
Joe,
the end of our presentation.
Thank you so much, Joe. Just before you end it, I'm having some great feedback from our investors, and I actually have a couple of questions if you don't mind asking them.
Yes, I see. Mark Sirota. Hi, Mark. Assuming the worst possible outcome, at what point could the preferred return end up being less than what's precised? So, that's a great question. So we always look at, what sort of return. It's great return, and he corrects at the bottom, predicated. So I've mentioned, Mark, that we have great experience with Joel Schwartz and his team. It's a unique scenario. Joel has he has a fantastic track record. You don't operate to such level of integrity without hitting some sort of snags or market cycles or being in all sorts of adverse situation. You always maintain the right way of doing business. He always comes up doing better than the year before. He's growing, he's expanding, and at the same time, he's always very, very laser focused. So we feel very comfortable about the individual and the track record. But you're asking what could happen in the event of. So we essentially got Joel, who's very, very well to do. Very, very well to do. We're talking about an individual. We actually, we went through audited financial statements because he floated bonds in the Israeli exchange, and then he had to go through and get rated by the S&P. Those of you on this call, you know what I'm referring to. Being rated by the S&P is a very serious thing. It's impossible to go through if you're not of a certain size and if you don't have an amazingly track record and a very substantial equity within your project and a very substantial cash flow. So what can happen? Everything can happen, right? I mean, the world is what the world is. We're seeking high double-digit returns, so things can happen. Let's call it force majeure. Let's call it an act of God. We have a personal guarantee by Joel Schwartz, so our capital is preserved. There's plenty of properties that he owns. We can predict what he's going to lose all his assets. We know the amounts of leverage that he has. So we think that we are giving, putting our trust and putting our partnership together with somebody who's definitely very, very worthy. Can there be a situation that the rents will drop to such a level? And I think this is maybe where your question is. Can there be a situation that rents will drop to such a level or expenses will rise to such a level that Joel will not be able to pay his coupon? Yes, there could be a situation like this. There has to be a very adverse situation. So we're not guaranteeing the return, we're guaranteeing the principal amount. So, if you go through certain cycles, the way we're structuring the deal, Joel cannot decide to pay us less. If you underwrite the deal, and that was a side conversation, the valuation that's being created here is tremendous. He might be paying us very handsomely, but the valuation is tremendous. So the drop in value has to be quite quite large, quite large, in order for something like this to happen. Secondly, if there's some form of a default in any way, we have the assets. Okay, we have, first position of the asset. We're holding 80% of it. Joel, in fact, is the minority, not the vice versa. And same thing goes to the second rollout. Once we stabilize from the first asset, we will remove that, our equity, and we move over to the second asset. And so we do the same over there, but we always have the assets. So we have the real estate, we have the signature, and we're not adversely affected by changes in the NOI, if you will, the net operating income of the building. Lastly, I think all of it is great. All of it is good and well. And people's are good as their words and as good as their signatures. I have a lot of trust in the individual himself. He has a lot of trust in us, created a wonderful partnership. He seeks our partnerships. He wants our capital. He wants our involvement. And he loves to operate the way he operates. So I think we have a good scenario here. But thank you for your question. I appreciate it. I see there's no more questions. Feel free to shoot an email, shoot me a text if you have any other questions, or if you want to talk about it, if there's something that you weren't quite sure about. I'll be very happy to speak with you about this. I do want to take a couple of moments and bring up another transaction that we in fact fully capitalized over 60 some odd days ago. And several days ago, one of our investors informed us, who actually taken a substantial amount of over, I think, 200,000 or over 200,000. We asked to scale back and keep $100,000 in a different transaction. It's called the legacy transaction. So I'll ask Laura to put it up on the table. We're closing legacy in a couple of weeks, probably in a week. So if there's still interest, and anyone here, if you feel that you missed out on legacy, I'm happy to take you very quickly through it, and then we can have a conversation outside of it. So again, we have a request to remove from a $200,000 investment from one of our very dear investors, to remove it to $100,000. It wasn't like any adverse situation, God forbid. And we can always do it after the fact. And there's no shortage of capital, God forbid, as well. We can always fill it up ourselves and do it later. But I wanted to take our time, and very briefly, I'll speak to you about the legacy project, and because it is somewhat similar to the Brooklyn project. So legacy essentially is, again, the second project that we're doing with a very large developer called Royal Palm Companies. Royal Palm is building in downtown Miami a 50-story tower composed of three main areas. The first area is a wellness center and office, about 140,000 square feet, leased out to a very large company with a cutting edge wellness and technology and just amazing things. So they're taking the majority of the space. They're spending millions of dollars to outfit the bottom portion of this building. The second portion of the building is 219 keys SLS Hotel. Those of you who are not familiar with the SLS, one of the largest hotel companies in the world, called Accor, that owns the SLS. It's a 5-star hotel. It's called a lifestyle brand. It's very happening with a lot of interaction. And then the last compartment is a 310 small condo units that are, designed perfectly for those who are coming to Miami to stay for a week, to stay for a couple of weeks, to stay for a weekend. But when they leave, they can release it through Airbnb or give it to the SLS hotel to manage it for them. So they come fully furnished. Those apartments are 98% sold. Deposits for those condo units, for the 310 units, 98% sold. Deposits are between 30 and 50%. So it's real deposits, real money. All this money goes into this project. We're bringing in a certain amount of capital, and we've created a preferred equity with a very nice cushion. So I'll take you through it very quickly. Again, we have 100,000 potential because one of our investors is scaling back from, I think, 200,000 or 250 to 100,000 less. Okay, and I'm assuming that is putting his capital with us on some of our projects that are coming eminently. So that's the project. It's a large project. It's a fantastic project. We are not majority here. Okay, therefore we've created a preferred position. The preferred position here, and obviously those who are interested will send you a presentation. I can go through it with it, but the preferred position here essentially allows for payment to you, the investors, of 6% per year. Then we have some sort of a catch-up of an additional 9% at the end of the project. It's a 4-year project, and a little bit of an equity kicker. So not to confuse things, the investor will get 16.2% on an annualized basis at the end. However, 6% of it is being carried interest all along. So every quarter, we're going to generate that portion for an annualized 6% ongoing, and then the balance will be at the end of 48 months. Can go through it. Very, very good. A very strong team. Second generation builders, over 40 years. Our other project we're building with them is 297 units, also here in Florida. These are Florida-based individuals. They recently have done first page in the Real Deal magazine because the loan that they've taken from Silverstein Properties, those who are familiar with the World Trade Centers and others in New York, was the second largest debt deal that has been done in Florida. So very, very substantial guy with many, many years of track record. Essentially, we've offered our investors $55,000, and that's sort of like the breakdown, 48 months, where you'll be returning based on that amount, $8,900 in annual return. That's your 6% that we create those dividends along the way, and then the additional 10%, 10.2% that will show up at the very back end. In this project, we brought about $1.146 million that we have set aside for friends and family. It was filled up very, very quickly. We're days away from closing, so whoever's interested, please let us know. Not that we need capital immediately. We can always, close the gap ourselves. But I do know that there was a good amount of interest, and not everybody got to participate. Information about our partner, Royal Palms Company, Dan Kotze, his information is here. Sort of like the other projects that they've been doing over the many, many years. Okay, so all this will be available. Of course, we have a full gamut of due diligence. We have the breakdown of financial summaries. It's quite a project. There's probably the name legacy is probably very well deserved. I think it's going to be Dan Kotze's one of his nicest projects, and he's a nice guy, and that's going to be one of his nicest projects. So I'm not going to dive into the financials. There's a lot to cover here. This is, by the way, these are the renderings of what the individuals have been bought. This project went like gangbusters. The units are coming fully furnished, managed by the SLS Hotel, again, 5-star hotel. And you just step into your own unit. The units went for very cheap also. It was like $400,000, dollars per square foot. Was about $950 per square foot, which is a nice number. But the overall price, compared to some of the other units in the area, in the general area, were abnormally low, considering the quality of the building, considering the type of cachet the building has. So it's a very interesting project. We only got interested in the project. These are the sort of like the various parts that we're looking at. The top portion is going to be a private club with an amazing pool, a gorgeous atrium skyline. The residence obviously is at the upper portion. We got the hotel, the SLS Hotel, at the middle portion. And we have the offices and the health and wellness center right above. The parking segments, a little bit of retail, and and then that's the building. It's quite amazing, and very, very high quality. So if interested, shoot a quick text to Laura, shoot her a quick email, and she'll send you the presentation. And of course, we'll share with you the presentation that I've had the pleasure of sharing this afternoon. Thank you very much, everyone. I want to wish you happy holidays. May the next year will bring only happiness and light and joy to you and your families, prosperity to all of us. Thank you very much. And above all, thank you for your vote of confidence. Take care.